I've got one slide on the Chinese economy. We've talked about this one. It's the same data. It looks a little different than we've shown in the past, but ultimately it's to say the Chinese economy overall is growing at a pretty okay rate. It is undershooting their goals of that 5% target long term, but 3.2% is not, it's not bad. What's really interesting about their economy, and they're seeing these divergences of the haves and the have-nots as well, where the manufacturing economy growing close to 10%, infrastructure growing around 5%. It's their real estate sector that continues to be a black eye on their economy. Double-digit declines this year. That was down double digits basically last year. And what's that mean? That means that you're seeing slack in steel markets, you're seeing slack in cement markets, and it really is weighing on, all things commodities within China. We'll touch on commodities and steel here in just a couple slides, but yeah, they really have an interesting economy where parts of their technological side of things going phenomenally. The build out of their grid and technological infrastructure going extremely well. But yeah, the real estate's really acting as a drag on commodities demand, specifically for steel and rebar and concrete.
And that really drives steel production, right? That's at a multi-year low in China.
Sure does. And it also drives steel exports. So we're going to get into the commodity section here. So I'm going to lean on my fellow panelists for some interjection to the extent they're willing and able to. But this is going all the way back to 2010. This is a chart of Chinese exports of steel. And it's just a giant smiley face. And we're back to levels that are right back to I'll even say Obama times, because Obama was actually the first one who put in place the steel tariffs on China. But we're back to those types of levels where if you annualize these numbers, these are in thousands. So that's about almost 10 million tons per month. So annualize that, you're over 100 million tons per year. That's bigger than the United States steel industry, just what they're exporting into other economies. So where the heck is it going? It's likely going into India. It's likely going to Russia, likely going to other Asian nations. And then, whether we like it or not, those countries who produce steel or aluminum are likely then moving their own production more towards Western economies like Canada, Mexico, and perhaps the United States. But this is a pretty ugly trend. And I personally think you'll see in my predictions, I think there's going to be some moves in 2025 and beyond to hopefully address these levels of exports, because they're pretty monumental, pretty sizable. With China's demand for steel rebar, steel sheet, and basically the weakness in their property sector, they continue to see extremely weak steel prices, as shown in the orange here on this slide. Those are local domestic prices in US dollars per short ton. They're trading down near $430. So a little off the lows that we saw 6 months ago, but not by much. You're still talking about an instance where you've got iron ore at $100, right around 100 per metric ton. There's no way these steel mills can make money with steel prices down that low. So they're likely being subsidized, but unfortunately up to this point, they're still producing at a very rapid clip and just exporting it into other economies. Northern Europe's a little better, but not that much better. In my opinion, they're still kind of sitting in recession territory as we sit here right now. Their pricing is more in the mid 500s. In the United States, while it may not look like it because we've just seen such massive cycles over the last 5 years, we have begun to see some upward momentum. It's not massive, but seeing it over the last couple months. Prices bottomed out, I'd say in August, right in the mid 600s. We're now seeing most indexes somewhere in the mid 700 range. And just this week, we actually saw one of the bigger upticks in hot roll coil that we've seen in a while, right, Mark?
Yeah, exactly. Yeah, we've been, kind of, bottoming out and they're, kind of staying around that, 600, high 600 level. And this week saw a pretty good uptick, I think $30 a ton ish to the index. So yeah, to your point, they're starting to see some upward momentum.
Yeah. And a lot of our viewers are probably saying, well, that's just because there's the risk of tariffs. And as soon as, the tariffs get taken off, this could come crashing back down. Well, not exactly. The story in carbon is one that I think even regardless of tariffs, I think looks actually somewhat optimistic. We've talked about this in prior Cup of Joes where, at least in my opinion, when you're in the 650 to 700 range on hot roll, mills aren't making a whole lot of money. And that was even with very, very low scrap prices. Well, over the last 6 months or so, we've started to see scrap prices pick up, and that momentum within that price pickup has accelerated in the last 2 months. In December, we saw scrap prices up by $20 per month, $20 per metric ton, and it's looking like we're going to see prices up another 40 or so here in the month of February. I apologize. 20 up in January, 40 up in February. I forget what month we're even in. But what's that going to do? That's just going to drive the cost up of producing steel for all of the electric arc furnaces here in North America. So, not coincidentally, and maybe Mark can run through the summary of what all we've seen, but just in the last week, we've seen several sheet mills announce price increases. We've seen several plate price increases. Mark, you might detail on a couple of those?
Yeah, so the one that gets a lot of exposure is Nucor CSP. They ticked up, I think, 15 this week. That's up from 10 the prior week. They're 775-ish. We mentioned the index up 30. U.S. Steel announced an increase. They're pushing $800 a ton. Cliffs has been at $800 a ton for a while. And as we sit on this call, looks like Calvert put an increase out there too to get hot roll up to $800 a ton. So yeah, to your point, tariff or no tariff, prices looks like they're going to start inching up for sure.
Yeah, and we've been talking about it for a number of months where just the fair value of producing steel was really we're grinding along that cost level. And and it just feels like, there might be, I absolutely admit there probably is a little bit of tariff risk that's getting priced into pushing supply chains maybe a little more domestic into the United States. But I think, the fact that you've got some tailwinds coming from the broader manufacturing space, I think there was, as Eddie mentioned, some latent demand that had been sitting on the sidelines that's now coming back into the market. I think that's helping. And then scrap prices certainly is providing a tailwind as well. Now, some of the things that's providing that, there's probably little extra support coming from the fact that in the month of January, we saw extremely cold weather across many parts of the United States, and that can impact trade flows of scrap. So, maybe as we head into warmer temperatures, we see scrap prices stable out and calm down a little bit. But that certainly added a little bit of fuel to the fire.
There's a question from the audience here. Speaking of demand levels, and maybe Mark, you can speak to this. She's asking specific to carbon. Are you seeing any regional pockets of demand translating into orders? Basically, at any areas in the regional areas that are higher demand than others?
Yeah. No, it's a good question. So, we mentioned data centers. We've seen that, for a while. Seeing some uptick in, energy markets, oil and gas, line pipe, seeing a lot of activity there. Mentioned, general fabrication, again, core piece of business of Ryerson, shameless plug. All the fabricators that we're starting to take an uptick as well. And then some restocking, a lot of the service centers, we took our inventories down, a little bit as commodity prices were declining in 2024, and we're coming back to the market as well. So yeah, absolutely.
And I was actually on a call with the CRU about a week ago, and one of the things that they actually referenced with regards to carbon markets, which is unlike the aluminum markets, is that the steel market's already pretty well insulated from a tariff standpoint on many regions of the world. Their estimation was that only about 18% of tariffs coming to the U.S. are really at risk of further insulation or protectionism. So yeah, we could see a bit of an uplift from tariff announcements and things like that. But it doesn't look as though it's going to be cataclysmic, particularly because, one of the reasons is the point of tariffs was to get more domestic capacity put in place. And we've certainly seen that over the last several years and going to continue to see it here in the coming years.
Absolutely.
With that said, if there is any risk, I would say the risk on Canadian producers of steel is certainly a little more elevated than the Mexico side of things. China's already pretty wiped out from a raw material standpoint. There are several hundred percent tariffs already in place on Chinese material. But Canada has had a slightly growing level of market share through the Stelcos and the Algomas coming into the United States. So there could be a little bit more of a hit there where supply chains have to get reworked or tariffs have to get figured out or absorbed, perhaps. But that's just to show kind of the relative value of Canada versus Mexico. But when we look at futures markets and how futures markets have responded over the last month, I think this chart tells a pretty interesting story. So 1 month ago data is going to be the orange line. A week ago is the blue line, and the most recent data is the white line. The point of this is basically to say, even though we had tariffs announced and then taken off, and we've seen scrap prices move up by rumored to be $60 in the last 2 months. We really haven't seen futures move all that much. So I would say a lot of this was already built into the financial markets, that, we'd already been grinding along the cost curve of many of these electric arc furnaces. A little bit of upside is probably warranted. You get a little bit of a tailwind of some seasonal effects of Q1, Q2 being a better time for manufacturing. And I think that was already kind of built into the markets. So, maybe $10 or $15 here or there, but not real massive moves on any of these announcements. It's a very, very different story in aluminum with regards to the volatility, but it's been kind of calm within the steel future space. So, I don't know if that's good news or bad news for our viewers, but financial markets haven't moved all that much with regards to where their expectations are for steel prices.
There's a question that came in on the Canadian slide you had. So is it the favorable currency, US dollar to Canadian dollar, that's increasing consumption of Canadian steel? Or do they have certain?
It's certainly helping. Yeah. I mean, the weaker currency certainly allows, and probably need to be slightly careful about this, but weaker currencies allow companies to export into the United States easier if their currency is weaker. So that's for any country. So yeah, for the case of Canada, to the extent their currency weakens or continues to weaken, that would allow them to absorb any tariffs it could put into place a little easier. And maybe they eat them, and maybe they eat the tariffs and just sell us, the same way they always had. Mark, you have any color to add to that? I don't know.
No, not really. I think there was a history there back when, steel prices were a lot higher than they were now, mills being able to do that. But, if steel prices continue to inch up, maybe that's more of a likelihood.
Yeah, that's fair. That's fair. With steel prices at 700 or 750, maybe it's not a real palatable discussion, but yeah, if we see domestic prices go up to $850, $900, which is possible, maybe that discussion gets a little easier for them.
We got a follow-up question south of the border, and feel free to abstain from answering if it goes out of bounds.
I'm kicking it to Mark.
That's why I brought you on, Mark. Mexican steel industry issued a statement claiming that U.S. steel exports to Mexico has surged. Could we see Mexico tariffs on U.S. steel stop the steel flowing into Mexico, potentially offsetting the flow of steel coming? So basically,
yeah. I mean, what's interesting is, I'm speaking very anecdotal, but what I would say is when the tariffs were getting, when we were basically that 11th hour of heading into the next day when tariffs are supposed to go into effect, China was very vocal about retaliatory tariffs very quickly. They basically had their list already mapped out. They knew what they wanted to target. Canada, same thing. Canada knew they were going to target things like U.S. beer production and bourbon production. They had a laundry list. They kind of knew what the playbook sort of was. And I don't know if this really matters, but Mexico never really did have a playbook. They never really did come out and say, if you do this, we're going to retaliate with this, this, and this. Is there a possibility that they're coming up with that list now, just in the event 30 days from now they go back into effect? For sure. Are they probably contemplating these things right now in DC, trying to negotiate with trade reps? For sure. So yeah, I would say there is a risk that U.S. production going into Mexico for, perhaps making cars or appliances, then coming back to the U.S. Those could be a risk.
Yep.
Bourbon and beer, that they knew exactly how to get to us.
Let's just get bourbon prices a little lower here in the United States. They've been on too much of a tear the last couple of years.
I hear you. Yep.
Last but not least, in terms of where we could ultimately see prices go, I'd love to hear Mark's opinion as well. But I think we're heading higher. I think we're in the early stages of a bit of a rally. But I don't think this is going to look or feel anything like what we saw in 2021, 2022, when prices went to $2,000, even $1,500 a ton. Could we see a 9 handle? Maybe, but when we look at capacity utilization, there's a lot of unused capacity in America and North America right now. If prices are going up into a level where mills can make a fair amount of money, they're going to do so. So, and the U.S. is much better suited to be a producer of steel. We have a lot more capacity here, and we have a lot more capacity that's going to continue to come online. So I think that's going to help to put a better ceiling in place. And when I say better for our customers. But I mean, I'm a risk manager and I love trading volatility, but boy, wouldn't it sure be nice if we had a tighter range of prices in 2025, something where everybody can be somewhat satisfied and make a little bit of money. But Mark, I don't know, you got any thoughts on where we top out?
Yeah, no, so it's a great point, right? I mean, with the additional capacity coming on, you got SDI Sinton, continues to ramp up. You got Big River 2, it's starting up. Calvert's going to have an EAF going probably by the end of the year. Then obviously Nucor's got the new mill coming online in West Virginia. Yeah, so this new capacity, right, could help, with a little bit of a price stabilization. But yeah, I mean, I think you're going to start this, the utilization number kind of tick up. I think we're in the mid 70s right now. I think ideally, everybody wants to see that number kind of in the mid 80 range. But the conversations that I've had early on with mills, yeah, they're starting to fill up. So absolutely.
Yeah. And then I don't have any slides on plate, but in terms of the plate market, oftentimes we've seen a trend where hot roll prices go, plate prices tend to follow maybe a month or two later. You think we're going to start to see an inflection higher in plate markets as well?
Yeah, we are. So yeah, good point. Because sheet kind of dominates the conversation when we talk about steel. But yeah, the plate market already this year been very active over the last 2 weeks. We've seen several increase announcements put out, and I think just in the last 2 weeks, I think around $140 a ton so far on the plate market. So yeah, I mean, plate markets is definitely moving up. When you think about plate market in uses, a lot of infrastructure that's slowly but surely, kind of gaining momentum, transmission poles, wind tower, even line pipe as well. So yeah, plate market is definitely on an upward trajectory.
Very cool. First, the wild card and the whole thing, we've gotten a few questions on it. Feel free to speak on it. The U.S. Steel subject matter. Got a few people asking, is there any updates or commentary we can make on it?
Yeah.
I hate the phrase, it's a fluid situation, but it's a very fluid situation. It's so fluid that literally as we sit here right now, I believe David Burritt, who is the CEO of US Steel, is in Washington, D.C., meeting with President Trump. Sounds like he's trying to set up another meeting with Trump and I believe it's the CEO of Nippon Steel. And perhaps not coincidentally, the price of US Steel stock is up, I think 4 or 5% today. Last I checked, which is kind of just a suggestion that maybe the deal is still, it's not dead yet. It's not fully dead yet. That's at least the read through that I take. Mark, I don't know if you got thoughts.
No, it's fair. I mean, this thing's been, dang near a soap opera, right? I mean, it's been going on for over a year. A lot of twists and turns. I at one point I thought it was, probably going to go through. I've given up trying to, prognosticate exactly what's going to happen with that. You got the mini mill with Big River, and people are speculating who's going to buy that. I think Nucor's name's been thrown in the hat. So yeah, man, it's who knows where this thing's gonna land. I mean, you think about U.S. Steel. I mean, it was one of the great names in American business, for a long time, and it's you probably argue that it's probably not our grandfather's steel company that kind of, I won't say hard times, but I think some maybe some mismanagement issues over the years. But yeah, we'll see where it goes.
All right. Flipping over to aluminum. First things first, where I would say things are a little more calm is on the LME aluminum ingot portion. We have seen a little bit of momentum in the last couple months, and some of that's due to the fact that alumina, which is a raw ingredient going into the production of aluminum, had seen a rally of about 100%. That started to unwind a bit. I think we're down 25% off the highs, but still elevated on the raw ingredient going into aluminum production. I think that trend is going to continue, that we're going to see softness in alumina markets. So, for the better part of 2 years, aluminum is one that we've actually seen a fair amount of stability on the aluminum ingot side of things. You can see I drew in this rectangular shaded area. We've been kind of range bound, basically right in the range of about $1 to $1.20. I personally think $1.10 to $1.20 seems like a somewhat healthy area where smelters are able to make money. It hasn't gotten too far out of hand. So, I see a fairly orderly environment within LME aluminum ingot. I've got a slide here in a few that'll touch on, supply demand expectations for aluminum globally. It is one of the markets where there's an expectation of continued tightness within the space. It's a market that's really seen pretty decent demand globally over the last couple of years, and thus pricing has been somewhat supported as well. But again, I tend to think $1.10 to $1.20 on the aluminum ingot side of things is roughly where we're going to stand. But
hey, on that one, I think you're spot on, Nick. I think that even the analyst, if you look back at some of the the publications that were out there in, November, December timeframe, a lot of them, I look back on those, they landed for 2025 in the 2,600 to call it 2,650 range. So
Yeah.
it's kind of that right where we're at right now. I mean, and
Yeah.
you see how we're trending to start this particular month between 117, 119. We could
Yeah.
see that trend kind of stay the same throughout calendar year 2025.
Yeah, and interestingly enough, I mean, tariffs really aren't going to have a major impact on the LME price itself because the LME price, again, that's the London Metal Exchange. It's a global benchmark. It doesn't really care about tariffs. But as Jeff had alluded to, where we are potentially going to see fireworks in one direction or another is on Midwest premiums. And so, why is that? The reason why we could see some potential fireworks, and I would say all eyes in the aluminum market are centered around Canada. Canada imports about 3.5 million tons of aluminum into the United States every year. So that's aluminum ingot. And I believe all of that's coming from Rio Tinto, right, Jeff?
I don't know all of the locations that it's coming from, but I would tell you even the numbers that you have there. I was going to comment that even 65 might be on the low side.
It might
Might
be
be even
effort.
slightly higher than that, with everything else that's going on globally.
Yeah.
I've seen and read some numbers out there as high as 80%. So it's a pretty significant amount of our overall aluminum.
And the math behind that is ultimately whether it's 65 or 80, it's a very large number. And if that all gets tariffed at either a 10% rate or a 25% rate, the simple math is take the price of aluminum, let's call it $1.20, take your tariff rate, if you call it 25%, and then multiply that times the percentage of aluminum that's coming in. You could see Midwest premiums jump by 20 to 25 cents instantaneously, which would take us to premiums that would be somewhere around 45 cents. That's a large jump from where we are right now, which is already pricing in some tariff risk, and we're only in the high 20s right now. A 10% tariff kind of puts you closer to about 30 cents for Midwest premiums, which is a little north of where we are. So, thus far the market perception is kind of reading it as, and I'll just flip forward. A month ago, there was an expectation we were going to see some sort of tariff risk. So a month ago, the market would look like the orange line. A week ago, the blue line actually was kind of the most bullish on premiums. There was sort of, a big expectation in the market that there's this looming risk that 25% tariffs were coming and it was going to blow up the Midwest premium market. Fast forward to where we are on the most recent data points, you've got the white line, which is there's still some tariff risk in the short term. You can kind of see that by the elevated Midwest premium points for both February and March. But there's actually beginning to develop what's called backwardation, which just means the line is downward sloping. And what that is, the expectation that at some point they're going to figure out a way to not have meaningful tariffs on Canadian aluminum. Because like I said, if it's a 10% premium, that's 10 cents slapped right onto the price of every bit of aluminum that comes into the United States. So that's going to be canning companies, appliance companies that are all going to see pretty meaningful inflation right away. I personally don't think, this is my personal opinion, I personally don't think that the administration wants to be dealing with, the automotive companies, the canning companies all showing up on DC's steps, lobbying for this sort of thing. So I tend to think clearer heads are going to prevail, and that's not going to be one that ultimately gets hit. I may be wrong, but that's my personal opinion.
I think it will be interesting, though, when you look at, as we get closer, we're on that kind of 30-day reprieve.
Yep.
As we get closer to that date, showing back up, I mean, we saw an interesting phenomenon on Monday with how big the spread was, 10, 11 cents between what the cash value was to what March is. And then instantaneously, once they made the announcement, it was delayed. That gap narrowed down to 2 to 3 cents, and it's really been trending there over the last couple of days. But as we get closer to that March date, that number, in particular, that futures number on the LME side, we'll see if that spikes back up again.
And I'll be empathetic with all of our listeners and buyers of metal, because this one, as a risk manager, there's not unfortunately not a whole lot I can do unless I have the brain of Trump in my hand, because it literally could be, tariffs are permanently off, in which case premiums come back down to right around 20 cents. Could be 10% tariff, which means premiums are going to land somewhere around 28, 30 cents. Or, somebody gets mad at somebody and 25% tariffs go into place, and we see premiums go all the way to 45 cents or 50 cents. There's no real way to really benchmark this type of thing. There's no way to yeah, there's no way to really know. So it's just going to be fully binary. It's going to go to one of those levels, and it's going to be probably a tweet that does it.
Typically, how do you plan for that then, right? I mean, you can't, you got to be planning ahead, right? So in a lot of cases, is it, I don't even know the question I'm asking, but like,
Yeah, no,
like what do they do in that situation?
So we have done a lot of hedging for customers in the last couple of months of customers just saying, even if there is a premium to do so, we get that it may not be the best number, but we at least get stability. We get a known price for our ingot. And that would include not just the LME portion, but also the Midwest premium. So we can contractually lock them into those numbers. I can't guarantee that 28 to 30 cents on premiums is going to be a good number or a bad number. Really don't know. But if stability is more important than getting a trade, right on the head, then that could be an option for our listeners.
At least it's a certainty, right?
Yeah, exactly.
That's right.
Yeah.
That's right.
So that's what we got on the aluminum side, unless there are further questions, which there may be here at the end of this. But last but not least, at least in terms of the metals that we deal in, nickel, stainless, it's been the most beaten up of any of the markets we deal in. Nickel prices are down basically by half since 2022. We're down around $7 per pound on nickel. And we've beat this one to a pulp over the course of 2024, but ultimately it's due to, in a large part due to Indonesia. Yes, there's been weakening manufacturing trends over the last 2 years as well, but there's also been rampant production ramp-ups in Indonesian and Chinese production of nickel. The growth rate of their growth over the last 5 years is shown in the gray line, and then their production numbers are shown in the blue bars. But it's been robust, and the question is really, at what point are they going to slow down their production and maybe even take some production offline? Because all they've done is deteriorate the pricing market, which is a market that they're really trying to control. This is a little bit of a complicated slide, but it's a pretty important one, which is to say this is a cost curve. And a cost curve is basically, as we go left to right on the x-axis of this, those vertical bars that are kind of stacked by color, those are all of the producers of nickel in the world. And so each bar is going to be a different producer. You can see if it's a wide bar, they're a very large producer. Skinnier bar, they're a small producer. And then along the left-hand side, you've got the price of nickel. And what you can see by drawing in these lines, so the white line is going to be that's the average price of where nickel was all of last year. So as we bring that straight across, you can basically see, okay, everybody to the left of that white line, they're still profitable. They're able to mine nickel. They're able to make money. And these guys all the way down here making a lot of money still. These miners over here on the right-hand side, prices have gotten down to a level where they are uneconomic. And what happens when things get uneconomic, you basically have to decide whether or not you want to keep taking losses and producing metal, or you shut in production. And at some point, Economics 101 says you should shut in production if it stays around those price levels. Well, prices haven't gone up. They've gone further down from 2024, and we're now sitting at the red line. So given where we are right now, we bring that across. You can see there's a much larger percentage of the global nickel market that is unprofitable at these prices. The whole point of this slide is it really is the essence of the saying, the cure for low prices is low prices, because if prices go so low, you have such a large percentage of the global marketplace that is not making money that at some point producers are going to start to go bankrupt. They're going to start to curtail production. And then only at that point can you start to see markets balance out. Somewhere in and around this area where we are here, I'm not saying we're at the absolute bottom, but somewhere in the 6 to 650 area, you've basically got half of the global production unprofitable. And I think at that point, you're going to start to see Indonesia and other miners around the world say, no mas, I don't like this game anymore. Let's slow down our production rates. And then you could actually start to see markets stabilize. So we're getting close. I think we actually are pretty close to that level, particularly if we see a little bit of a pickup in demand, both within North America as well as within China. Now, the one wild card, we haven't seen a whole lot of movement just yet, but molybdenum, we talked about at the onset, it is at risk a little bit from the Chinese export restrictions. So that's one we're going to keep a very close eye on. It doesn't impact most grades of stainless, but it would impact some specialty grades like 316. I guess, Keith, any thoughts or comments at this stage?
Well, I was wondering, Nick, if you could expound any on Indonesia in particular, because didn't they announce some type of curb on exports of nickel for 2025?
Yeah, they've so the early stages of them kind of talking that they're going to slow down their production and curb some exports is kind of the early stages of what I would expect to be the type of rhetoric you would see around a bottom. Now, I'm not saying we're at an absolute bottom, but yeah, Indonesians, I think it's like the mining ministry or something like that. They basically said, yeah, we're down into a price range where we don't like this game. We don't want to just keep driving things lower and lower and lower because we're actually kind of hurting ourselves a little bit. So yeah, that's the main theme for 2025. And it's one of my predictions for the year as well, that I think we will soon see some sort of stabilization and maybe even a little bit of an uptick in nickel and thus stainless steel surcharges.
Heath, are you hearing anything different at the mill side? I mean, how are they reacting to this?
Well, really, from a raw material standpoint, Mike, because stainless mills are more scrap oriented, the 90+%, let's say at NAS and Outokumpu in particular, more than 90% of the raw material going in their furnaces is scrap. So they need about 10% of the mix to be pure nickel or moly or whatever the additives are, so they can dial in the chemistry. I have heard some rumblings about the potential of nickel coming out of Canada if that gets caught up in some of the tariff wars, but I guess we're still, about 26 days away from hearing more about that?
Yeah, that's right. I mean, with regards to the rare earth side of things, I think Canada is going to be a big potential partner that we're going to need to keep close to, in my opinion. Greenland is one that's been floated around as one, and even Ukraine is one that, as part of the ceasefire deal, there's a potential that the U.S. administration asks Ukraine to kind of supplant that rare earth supply into the United States as part of the trade deal and the money and military that we've supplied. So we'll see. There's a lot of moving pieces again. So last but not least, before I go into my quick predictions, I know we're edging right up on that 90-minute mark. Quickly on the nickel side of things, pretty interesting. Most analysts are actually calling for a small surplus, but the reason why I highlight this is it's a much smaller surplus than what we've seen over the last several years. And I think a lot of this is predicated around what Keith and I touched on, which is I think at some point Indonesia and perhaps some other miners are going to blink and they're going to say, I don't like this game of low prices. This isn't a fun one. Let's shut in some production for a period of time, let the market react a little higher, then maybe we'll think about where things are. So the expectation of these massive surpluses that we saw in 2022 through 2024 appear to be moving further into the past. And I actually think we're going to see a much more balanced market within nickel and stainless steel surcharges for not just 2025, but here over the next couple of years. Looking at aluminum, Jeff and I already talked about this, but the economists are actually somewhat bullish on aluminum going forward for the next couple of years. Supply demand conditions are pretty well balanced. I don't think we should expect any massive shortages or anything, but certainly balanced markets, which probably at least keeps us in somewhere in the realm of like $1.10, $1.20 on LME markets. And you can see that's roughly where at least this particular bank, Macquarie, is forecasting things, kind of in the $1.12 to $1.30 range for the next 4 years, which is a fairly tight range for aluminum markets. And then last but not least, I know we have some entities who are dealing in the copper markets. We don't do a whole lot in it, but I wanted to supply this slide, which is just to say that the tightness that we had seen from 2020 through 2023 and 4, most are expecting that there are going to be enough production ramp ups that are going to exceed demand and provide a little bit of a cushion and hopefully a little bit of a ceiling on copper prices as we roll through the next year. And that's even with regards to the big grid build outs for the electric grids that we're expected to take
Nick,
place.
if I could hop in there, we have been seeing with the data centers that copper in particular is in a allocation situation from both Premier and Hussey Copper. So
interesting.
We've been importing in copper bus bar and depoting that, and we're getting a good reaction from customers on that because it's in extremely tight supply.
So you said that's on the bar side, not the wire side?
Well, copper bus bar, it's the flat bars that are inside of electrical control panels,
Okay.
and data centers have a significant amount of that.
Very interesting. Yeah, I'd be curious if that's a domestic issue versus if suppliers around the world are kind of seeing that kind of tightness.
Great question.
Interesting. Well, yeah, that would certainly go in the face of what this particular bank is seeing in terms of supply demand
Oh,
balances.
this isn't the raw copper. This is
Yeah, sure.
the refined copper, the milled, C110 bus bar type product.
Yes, could be more of a refining issue than anything. Interesting. Okay. All right. So we'll obviously take some Q&A here at the very end of this, but five quick predictions from me, and obviously Mike and we'll revisit either in December or January,
Yeah.
here in about 10, 11 months.
We hold your feet to the fire for sure.
Yeah, let's do it.
December, I mean, you went 4 for 5 last year, right?
I think that's right. Yeah.
Yeah. There were a few softballs in there, but let's be honest.
So some of these we already teased, but I am going to make the suggestion we are going to see this is the whole theme of the presentation. We are going to see a reversion of the old economy catching back up to the new economies. And what I would use to benchmark that, we can use ISM manufacturing relative to services, or if you want, we could use some of those ETFs and look at their stock performance and do it that way. I'll look at both, and I'm obviously on record. I'm being recorded right now, so we will certainly check back in on those. But I think we've provided some evidence that suggests we are going to see some real optimism around manufacturing here in the first quarter or two at least. And so I think that's the first and foremost the big one for me. Higher volatility. If you've been listening at all, I think we're getting economic policy, trade policy coming at us, 10 times a day via tweet, whether it's Trump or Elon or somebody else. A lot's coming at us very, very quickly, and it's moving markets, it's moving metals markets. And so I think as measured by VIX, which is the volatility index, I think we're going to see on average throughout the course of this year, higher volatility than what we ended 2024. Because there is some optimism in the manufacturing space and with regards to commodities and industrial metals demand, I do think we're going to see broad inflation metrics remain elevated for much of this year, barring some sort of recession. And that's not part of my prediction. I do think we will see inflation actually remain pretty darn sticky and move a little bit higher even. With that, I do think nickel markets at some point in the coming weeks or months, I think we're going to begin to see some stabilization. And I will even say, I think we're going to see nickel markets finally turn higher on a year-over-year basis in 2025. A lot of that's centered around what Keith and I talked about, which is at some point, somebody's going to blink, somebody's going to curtail some production because prices got too low, and then markets can balance out a little bit. You sprinkle in a little bit of manufacturing positivity from China or North America, and I think that one looks pretty interesting, either from a hedging standpoint or from a trading standpoint. Again, not trading advice, but these are just my predictions. And then last but not least, I think we're going to continue to see a growing global cry around Chinese steel exports, and I think not just here in North America. I think other nations are going to see their local economies and local manufacturing industries really getting hit by these gargantuan numbers of Chinese exports. And I think there's going to be a more global concerted effort to really try and block off, whether it's with tariffs or with quotas or whatever it may be, to try and get those down. Hopefully at some point, it just means China produces less steel because the world just really doesn't need it and doesn't want to have it subsidized. But I think we will see a reduction year over year in Chinese steel exports, and hopefully that trend reverses lower over the course of 2025.
Okay. Locked
That's
in.
what we got. We're locked in.
All
We're
right.
locked in.
Beautiful.
All right. Before we hop into Q&A, I don't know if anybody else is like me, but I get very antsy when we're in the middle of the month and we're so far away from the next cup of Joe. I feel like Pablo Escobar, just standing out in his courtyard, thinking about life, just pondering things. Mike, I'm going to kick it over to you for some good news.
Yeah, and we'll put here some slides here at the end, because what do you do in between these cups of Joe? I got a QR code here on the screen. Scan that. We do a monthly market report. It's basically it's some market trends, right? A little bit of what we cover here in Cup of Joe, but then also some commentary from product managers, some of which here are with us today. So scan that, make sure you're signed up for that, receiving that. That's a good one. Highlighted here, we have what are called our employee creators. Nick is one of those, pointing out some stuff on LinkedIn. So definitely he's a good follow. And then we do some basics around Metal 101 and Metal 102. So more information to come on those. And then last but not least, I like to say that, if you notice, Nick always does that in his final 4 slides on each episode. It's always last.
I can't
but
help
not least.
myself.
I don't think you. Please scan this QR code. We'd love to. We asked earlier about what you're feeling about the marketplace. We got a few questions. Would love to get your insight. That helps us shape some of the content for Cup of Joe. Some surveys that we do. So scan that QR code, please. And I would love to get your insights. 7 simple multiple choice questions. Would definitely appreciate your insights.
Awesome. With that, to the extent there haven't been questions already asked, or
I tried to pepper them in as much as I could throughout,
Yep.
and I know we're over here, so I think what I'd like is maybe could each of you give us one thing you're watching, not named tariffs, not tariffs.
Mike, can I ask one question to the product managers while we have them all on here?
Oh, absolutely.
Because
Yeah.
I think one thing that we didn't talk about is for our customers who are hearing about tariffs, not tariffs, there's plenty of capacity out there. I think for many of our customers, some of them don't even care as much about price. They want to know, are you going to stock me out? Is there going to be supply? In each of your respective markets, I guess, how do you feel with regards to having sufficient supply chains for what may be the volatility that we see ahead?
Yeah, I'll start. On the aluminum side, current state, I do think that there's still availability, and I say that broad stroke across the sheet and coil, the plate side, and the in particular the soft alloy extrusion side. But certainly you see it in the cold finish side as well. But as I touched on it earlier, as we're starting to see some pretty optimistic forecasts that are coming out, I do anticipate we're going to start to see some tightening in that. Now, does that happen in the first quarter, or does it happen in the second quarter? That's to be determined, but we're starting to already see it in some of the data that's coming out, even that's been reported out for the month of January. So right now, okay, I would call it for aluminum, but we're going to watch that throughout the year because it could start to tighten up.
Okay. Mark, how about on the carbon side?
All right. Yeah, no issue carbon side. I think we're good. We talked about additional capacity, right? Coming online a little bit. So I don't see any issues on the carbon side whatsoever.
You think if anything on like if Canada gets hit, for instance, you think if Canada gets hit, it's just a function of if we can still get it, it's just going to be a little more expensive?
Yeah, a little bit. Yeah, I think that's, remains to be seen how they ultimately play it out. How do, steel prices go? Do they help absorb some of that, tariff? All will be, conversations to be had. But yeah, I absolutely think that's the way to look at it for sure.
Okay.
Yeah, I'd reiterate that on the stainless side. I mean, I don't think that Ryerson would struggle to get stainless supply. And I feel confident we'd be in a strong position. There are some countries where there's a significant amount of stainless flat roll that comes in from those countries. Taiwan, you mentioned Indonesia, Nick. They've been integrating their production quite a bit to be able to offer and the coil products themselves instead of just the raw nickel. So if there's tariffs there, we could definitely see some tightening of supply. But I feel confident we'd have the metal to be able to take care of our customers.
That's a really good point. And I actually saw before he hopped on here, the new trade representative, I want to say his last name's Greer. He was actually specifically mentioning Vietnam as a nation who he doesn't believe, in his opinion, that they're holding up, their end of the bargain with regards to trade. So, we talked about a lot of things here on this podcast today, but keep in mind, this is going to be a moving target. There's going to be a whack-a-mole going around from a trade perspective, a policy perspective. So more to come. There's always more to come, but it seems to be coming faster than ever. But those are all great points.
Yeah, and I think that touched on it. But like I said, peppered the questions throughout, and appreciate everyone's time today. Is there one key takeaway, not related to tariffs, that each of you would like this audience to get away from, to take away from this for your respective metals? Jeff, start with you.
Well, I mean, again, it's tough on aluminum not to use the word tariff in there, but from our end, it's the ingot side. When we're watching what's going on with ingot, and a lot of it does tie back into what's going on with tariffs, but that's the one that we're going to be watching. And maybe your next cup of joe in the next month or two, when we see what happens with, in particular, Canadian tariffs, if it does happen or if it does not, if I can join you again to give you a bit of an update on where those numbers go. Because I think I throw ingot out there on the conversion side, the opposite side of that, the component of our cost, I do think that that's a little bit more on the stable side. So it's really watching what's going on with ingot, mainly on the Midwest Premium. And he said, don't use the word tariff, but I got to say it's tied in. Just the reality of it.
Yeah, absolutely.
What I'm more concerned about than anything else is that as business has slowed and we've seen contraction in the market, there's been a move across the industry to reduce inventory. And our customers have reduced inventory, especially in stainless, where nickel prices have been falling and falling and falling. So people just don't want to get caught with that higher costed nickel when they can buy it. If I buy 3 sheets today, that gets me through the next 2 weeks. Maybe nickel will be lower again. So when the economy does pick up, and we really think it will, I think there's going to be a whipsaw effect, and we're going to have some challenges across the supply chain in getting enough metal in a quick enough fashion to meet customers' needs.
Sounds like a prediction to me.
Well, I guess this is recorded, so we can check it in a year or 6 months.
Thanks, Keith. Mark, any closing thoughts?
Yeah, no, kind of, piggybacking off what Keith's saying, if keep close contact with your local salespeople, your local branch, within Ryerson, if you're on the fence about, obviously purchasing anything, I think, now's the time to probably do it. I think things are, as we talked about, and carbon space probably going to tick up a little bit. So yeah, I mean, I would just keep an eye on things. I constantly watch lead times to see where they're going. So just, stay plugged in, stay as close as you can into the market.
Yeah, and I would just leave everybody with, if you're on the customer side, stay close with your salespeople. If you're, one of a Ryerson salesperson, stay close with your product managers, like the ones here on this call. And they're all staying close with me. We want to be on calls with all of you as much as we can, whether it's via a cup of joe or in person or over a Zoom. Information is going to come fast and furious, and it's going to be a lot to digest, but I think the key takeaway from today's presentation is the pins are up, the alley is waxed. We've got some tailwinds behind our back, and we've got a good ball in hand. Let's knock down as many of these pins this year as we can. I think it's going to be one where we can all have a pretty successful year together.
Let's hope
nice way to tie it all together.
Nick. Let's hope it's a 219.
That's right.
219, not a 19, right?
Nick, I tried to cue the turkeys, but they're not cooperating.
Let's get some turkeys.
I apologize for that.
Thank you, everybody.
Thank you.
Thank you.
See you next month.